Welcome to the Beckonomics Podcast. I'm your host, Victor Beck, here alongside Hunter Beck, as we break down weekly market movements, macroeconomics, and what investors should be keying into as we look forward in this market environment. As a note, the topics discussed and opinions given are not intended to address the specific needs of any listener. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Beck Capital Management may maintain positions in the securities discussed in this podcast. Hi, Hunter. Well, I'm excited to get into what's really the end of the 2023 reporting season. Go over some earnings, some numbers, and what's going on with the markets right now. How about you?
Yeah, lots of good stuff to cover and a little bit more good stuff to come next week, but we will get to that and let's recap what we've seen so far.
Sure thing. So as of Monday, 65% of S&P 500 companies had reported their Q4 2023 earnings, and results have been pretty good so far. 73% are beating, what their net income expectations were, and 64% are beating on revenue estimates. And kind of on a high level, healthcare, staples, industrials. I'd also like to call out discretionary as a sector that's doing well. And then, of course, tech has been a major focus. AI continues to be the focus of those earnings reports. And it's really been, as we've mentioned before, those hardware manufacturers that have really been producing stellar results. The software companies, and we'll talk about this a little bit later as we go through some of the reports, but they've been talking about all the money that they really are spending in that capital expenditures to kind of build out that AI infrastructure. It's also important to note that through this earnings process, we have seen some pretty good appreciation in the S&P 500 year to date. The price to earnings ratio, kind of a key valuation metric that a lot of investors look at for the market, is now over 20. And I just kind of look at that as a big way that tech has kind of influenced the S&P 500. Those are higher valuation companies. They've really grown in price. But what we've been seeing through this earnings season is that those earnings expectations have stayed pretty positive, which is kind of helping support that valuation. You want to run us through some of the things you've been looking at?
So on that PE that Victor is talking about, so that's also including a lot of growth. Like you said, from all the tech companies that have been reporting and now make up such a big percentage of the S&P, those are the fastest growing in the market. NVIDIA just overtook Amazon to be the third largest in the S&P 500, and it's doubled its earnings over the past year. It's growing at a rapid clip, and so that 20 PE might seem scary to a lot of people, but it really underlying that there's so much growth behind it, which is driving that number up. And then one more thing I want to comment on, you talked about the companies beating their earnings expectations. Well, I think it's worth noting that those beats, in my opinion at least, are worth a lot more today than they were in the previous years. Previous years, excluding COVID really, the market's been moving rapidly. The economy's been going fast. And so in this new environment where the Fed funds rate is at 5.5 and businesses are tight, credit's expensive, these beats mean a lot more coming from these companies. And we'll take a look at some specific examples, but we've seen that a lot in cost controls in a lot of companies, and then obviously the AI growth that we've seen elsewhere. And then to highlight a few of the sectors that have underperformed so far, we're looking at materials, energy, and financials. Financials are underperforming because of that Fed funds rate, because interest is high and they're being stretched. Commercial real estate prices are down, especially office buildings. And there are a lot of factors weighing on financial companies right now. Banks, by and large, have been under pressure for the past year. So that's no shock that they're relatively underperforming the rest of the market. Energy and materials, I'd argue, is primarily a function of lower commodity prices than we had all of 2023. And, as those have continued to normalize from COVID and energy and oil price dynamics have changed, those have kind of moderated back out a lot. So that's no surprise either.
Well, let's go ahead and dive into some of these companies. What do you say?
Yeah, sounds good.
So we'll start off with the Magnificent Seven. Of course, everyone's been talking about them, some of the largest market cap companies in the entire world. And speaking of large market cap companies, we're going to lead off with Microsoft, who has surpassed Apple to be the largest company in the S&P 500. Now, part of the reason why they surpassed Apple is because they did perform really well on their earnings. They had strong EPS upside, strong revenue upside. Pretty much all of their business segments performed either at or above expectations. Their business process revenue was high. Their intelligent cloud revenue did well. And even their personal computing segment did well. Azure, their cloud infrastructure business, that growth was higher than expected. That's one that a lot of analysts key in on because it is so profitable for their business and they expect really high growth. That came in at 28%, which is pretty significant. It shows continued growth in that cloud segment that's doing well. Their Xbox and gaming business also performed well. And so just kind of across the board, they showed really good results leading to that outperformance of some of the other companies in the days following. Forward guidance at least, was pretty much in line with expectations, but analysts were pretty satisfied with that. Business is looking good moving forward. They are one of those companies that's really focused on some of those cost-cutting initiatives. And I think a broad theme of what we're going to see as we talk through some of these earnings is that by cutting those costs, these companies are going to be able to preserve their margins, preserve their earnings. We talked about the belt tightening in our last podcast, and that's really shown through in these earnings reports. Moving on, I want to talk about Google, and they did okay. They did report upside on EPS and revenue. Their key advertising properties were mostly in line on revenue, and search performed pretty well. The big thing with Google was that they are going to have high CapEx as they invest in a lot of these AI capabilities. So they reported the key takeaways that AI is bolstering their search, making that better, making it more profitable. And their subscriptions are enjoying really strong growth. Their cloud growth is accelerating, and beyond that CapEx spend, their business really looks intact, and they've performed fairly well since their earnings. Now we kind of got the good, the okay, and maybe now the ugly might be Apple. So Apple disappointed investors to some extent, and that was part of the reason why Microsoft was able to surpass them in market cap. They performed decently. They had upside on revenue and EPS, but their China revenue was extremely soft. So they disappointed there by almost $3 billion. And they're just seeing a lot of competition from those domestic phone producers, domestic hardware producers in China. And that's going to be a headwind for them for some time. The Chinese economy that we've mentioned in prior podcasts is not performing as well. And so Apple, who's pretty reliant on that Chinese market, is going to have a little bit tougher time performing on a go-forward basis. And then going back to what we were talking about valuation, Apple is at a higher valuation that is somewhat justified because of just how much cash flow they generate every single year and every quarter. But that's going to be hard to see that valuation expand too much when you don't have those underlying market benefits that are going to help their stock price increase in kind of this near-term environment. Hunter, you want to run us through a few more of the Mag 7?
Yeah, sure thing. So we're still waiting on NVIDIA, like I mentioned. So Victor got the first three. I'll take us through the next three that I've reported so far, starting with Amazon. Amazon had a great earnings report. Overall, just solid across the board. The biggest standouts were their AWS growth. Like Victor mentioned with Microsoft, those cloud computing segments have been so important for these companies. They're huge margin businesses, and AWS posted another great quarter of growth on that from a top line as well as from a margin perspective. Operating margins expanded a whole lot, and revenue is higher, which is just a great combination. Additionally, investors really liked seeing their core North America business do very well. Big margin expansion there as well, coming in 1.2% higher margins, which brought them to 6.1% margins overall, which is a huge increase on such a high throughput business. Think of all the Amazon purchases you make, that's a huge revenue number, and to be able to increase that margin just a little bit drives so much more in earnings. It also speaks, to their core business, speaks to the strength of the consumer right now, which has been a big question mark for a lot of people recently. So huge report for them. Stock price definitely reflected that as well. Speaking of another huge report, Meta's undergone over the past year or so a huge cost-cutting campaign. They've let go a lot of staff, cut a lot of the bloat that they accumulated over the years of rapid hiring and huge spending. They continue to cut costs, which investors always like to see, but also they grew top line revenue very respectfully, which, that combination drove a huge earnings beat, as well as they initiated a dividend of only 50 cents per share per quarter, which is very new for them. And it's a relatively small on a percentage basis right now, but just signaling to investors that there will be that return of capital, that now that they're a much leaner business, they can afford to pay out on a consistent and regular basis. They've always done share buybacks for a long time, but adding a dividend is a much more firm commitment to paying out capital to shareholders over time.
Yeah, just a quick note on that. Companies really hesitate to ever drop their dividend. So by instituting that dividend, it basically says, hey, we're going to at least pay this much on a go-forward basis. So that's why these big tech companies, or just tech companies in general, wait as long as possible to start paying out those dividends, because they're not super excited to say, hey, we're going to commit to this quarter over quarter from here into essentially perpetuity.
Exactly. That's why they all stick to share buybacks, which serve a very similar role, but they're a very discretionary basis. They come and go as the company feels comfortable doing that. And so finally, to take us into the last of the Magnificent Seven that I've reported so far, Tesla reported, and they're kind of another one of those ugly reports. Tesla's been facing a lot of pressure in a higher interest rate environment with just a lower broad demand for EVs, for that whole segment of green energy, kind of solar panels and batteries and all of that. So without a huge driver for additional revenue or earnings, they're still in a tough spot of margin contraction through lowering the price of their cars to try and be more competitive with your cheaper internal combustion engines, despite additional efficiencies that they've been driving through their manufacturing process, which has been a huge thing for Tesla over the previous years, are driving those costs of production down. But they've kind of hit this, what they're calling a natural limit of cost down. At a certain point, it's going to cost you something in raw materials. They've cut a lot of that out, and they've done a really great job in making that as efficient as possible, but they're getting to a point where car prices are low enough that they're being pressured on the margin front. And so really what the market's looking for right now is, like I said, some kind of growth vector. They're working on their next gen vehicle, which many people are expecting to be their ultra cheap consumer car that can just take over huge swaths of market share, as well as the market's waiting for autonomous driving to become a reality. That's been a year away for the past decade, according to Elon. And until they get that sorted out, the market doesn't really see a great near-term growth vector. So lots to look for in Tesla in future quarters. This one, not a great one.
Yeah, I know personally, I'm very excited for that autonomous driving. Commute to work isn't too bad right now, but if my car could do it for me, I would certainly appreciate that. Getting into a few companies that our listeners are probably familiar with, we mentioned industrials at the top of the episode. One that I want to call out is General Electric. They reported really solid upside on their EPS and revenue growth. This one I would just want to mention because a broad-based industrial company like GE that's been performing really well on a stock price basis lately, the fact that their earnings are coming through positively too just shows that it's nice to see a traditional industrial blue chip company doing well as a representation of how the broader economy is doing. So whenever you have that business industrial spending, along with kind of consumer products that are geared towards the nuts and bolts of the economy, a company like that doing well really bodes well for where we're going on a go forward basis. One company that is near and dear to my heart, Chipotle, they reported really solid EPS and revenues again. They continue to surprise investors. They're trading at a really high valuation, actually, at almost a 50 PE on a forward basis. But they continue to show that they're able to expand their margins. They're implementing new efficiencies in their restaurants, and they're opening a lot of new locations. So they opened 300 new locations over the last quarter, and they don't seem to be slowing down. Every single time I expect, hey, maybe they're going to encounter some margin pressure. Hey, maybe the restaurant growth won't quite be what it's chalked up to be or what they guide. They continue to beat expectations, and that stock has performed extremely well. They also really have that built-in benefit. They're kind of in that sweet spot between consumer spending having to be enough to dine out and also being a cheap high calorie option for people that gives a lot of value to their customers. And the way that they're able to control that food production process has really just helped them perform extremely well over the last few years. Then finally, something that I'm sure all of our listeners use on a regular basis is Uber. They had a great earnings report. They've been one that's struggled with profitability in the past, but it really seems like they're coming into kind of the new era of earnings and revenue growth. Their bookings were really strong. We've really come out of that COVID period that them and Lyft really struggled under. And now people are back out and about taking rides, and Uber's really benefiting from that. So their portion of rideshare really exceeded expectations, and they're looking really solid as far as where they're going on a go-forward basis. Kind of pivoting back to what you said about Tesla, the autonomous driving revolution, once that comes to pass, is going to be a huge benefit for Uber, at least potentially, if they have a bunch of cars on the road that don't require drivers. That's not something they're talking too much about yet, but definitely something that we're watching when it comes to them. Hunter, you want to run us through a few more?
Yeah, sure thing. Taking us back to the tech and AI space, Netflix had some really great earnings. They reported huge upside on subscribers, with net paid ads growing by 13 million, which, like it or not, as a consumer, Netflix's crackdown on account sharing has really paid off for them financially. It's nice to be able to share one Netflix account between your family and maybe a few friends, but Netflix has done a great job of retaining customers while also making everybody pay for it, whether that's allowing you to pay a little extra to have additional accounts on there, or the new ad-supported lower price tier. It's driven a lot of earnings and been really great for their company. One more key thing there that I think a lot of people will find interesting is Netflix is no longer interested in buying legacy assets, meaning movies and TV shows produced by your traditional companies. We're going to be seeing more and more, which we already have, but seeing more and more of those Netflix branded movies and TV shows on their platform. Moving on into some of our more AI names, Intel had reported good earnings with margins above expectations, earnings above expectations. However, it tells you a lot about where the investor is at today, because it's not what they reported, but really how they reported those earnings that investors didn't like. So your data center and AI related sales fell 10%, and is really the consumer PC business that really drove those earnings. This was a what we would probably refer to as a low quality beat. Your traditional consumer drove all of the earnings, but the AI, where all of the interest is, where a lot of the stock price appreciation has come from, the AI and as well as their foundry business, that all disappointed. So their stock was down low double digits following this earnings report, purely because of how they reported the earnings and where those earnings came from, as opposed to the earnings themselves. One more thing worth mentioning is that their March quarter guidance was light. So low forward guidance definitely contributed to that poor price movement that we saw. And then finally, IBM, solid earnings beat, additional margin strength, kind of a story that we've been hearing a lot as we've been walking through these earnings, is the margin expansions. We've seen a lot of cost consciousness in these companies, as well as some good revenue growth depending on the company. But the important thing about the IBM report was that management started talking about additional AI exposure. They're really positioning themselves as an AI company. And as we've seen over the past days since their report, the market really likes it. Their price has appreciated about 9% since their earnings report, pretty much because they're positioning themselves to be a big AI player, which counts for a lot these days.
Something that I'd love to mention as we kind of start to wrap up here is that the activity, we mentioned the energy industry at the beginning of the podcast, and you called out that they haven't been performing extremely well. A lot of that, of course, due to oil prices. But we've seen some really interesting activity in the energy space, a lot of M&A, mergers and acquisitions. We saw last year in 2023, Exxon buying Pioneer. That was one of the largest recent oil acquisitions in the market. But we've seen a lot of activity just so far year to date. A few to call out: Devon is buying Interplus. That's both of those are relatively small producers, but what they're trying to do is improve their efficiencies. All of these that I'm about to mention is really around, hey, can we get more acreage for our wells? Can we restructure our contracts better with a larger company? And can we, provide efficiencies that are going to make our cost per barrel of oil or per unit of natural gas even better to expand those margins? So Devon is buying Interplus. We recently saw that Diamondback is merging or acquiring Endeavor. Endeavor is a private company in the Permian Basin, and those companies are almost equal in size, but that is going to be a productive merger for those two companies. And then finally, we saw that APA is purchasing Callon Petroleum. So we've seen a lot of activity in the oil space, and that's going to be really interesting to monitor on a go-forward basis. I also want to call out before I have you wrap up, Hunter, that of course, as we mentioned, these companies and their earnings, most companies do beat earnings expectations. So as we note on these earnings, we kind of called these out because they're interesting reports that provide a broader macro story, but these are not endorsements of any of these companies specifically. But it is interesting to see those macroeconomic implications that some of these reports have, whether it's AI and tech, whether it's the consumer, and whether it's industrials fueling the broader economy. So Hunter, do you want to kind of wrap us up here? Tell us, tell our listeners what earnings we're looking forward to as we complete this earnings cycle, and kind of what we're keeping our eyes on.
Yeah, thanks, Victor. So as you said, we're looking at earnings from a number of angles, and from taking a look at the consumer, where the consumer is, how consumer spending is holding up. We have Home Depot and Walmart both reporting next Tuesday. Coming off the heels of the Amazon report with their solid North American business, we would expect and hope for that to continue into the Home Depot and Walmart reports. But these are definitely companies that are more concentrated on the consumer. They don't have Amazon Web Services. They don't have huge cloud businesses or tech businesses that can support poor retail sales. So Home Depot and Walmart will be very interesting to see because there's been so much macro talk about the strength of the consumer. When are they going to run out of excess savings? Because we've seen that number come back down from post-COVID. So that'll be great to watch from a consumer standpoint and from an AI standpoint. We have NVIDIA on Wednesday, and what I would argue is the most important earnings of the quarter. NVIDIA started this whole AI rally and has now, like I mentioned earlier, overtaken Amazon as the third largest company in the S&P 500. Expectations are huge. Forward guidance has been really good, but the market won't be satisfied with a meet on the guidance that they provided. The market's expecting the stars, and NVIDIA's share price in previous weeks and months, has shaped it up for those huge expectations. So it'll be big, but that's what we're looking forward to.
Yep, it's definitely been a fun earnings quarter to track, and looking forward to the rest of it.
Yeah, certainly are. Thank you, Victor.
And thanks to our listeners. We'll catch you next time on the Beckonomics Podcast.